Thank you so much for your very kind welcome this afternoon, and in particular to my hosts, Professor Lucantone, Professor Lehner and Professor Di Noia. And it's marvellous news to hear he's been appointed to Consob. It's a great pleasure to return to Lewis and to meet colleagues from Tor Vergata also. I'm always particularly impressed by the quality of the work and the enthusiasm and energy of the students here. So thank you so much for being here on a Friday evening. Now, I have just one slide. I thought better to avoid death by PowerPoint. So I speak here to the students. You have to listen to me. I will speak as clearly and as slowly as possible, but I understand it's being filmed, so that will be there as an aid to revision. So being invited to speak on Capital Markets Union is a dilemma. Now, recent reforms, so back as far as 2008, I think generate an existential crisis for the academic lawyer, because if we look at the leviathans, the giants of the crisis era programme, so MiFID II, MiFIR on markets, this contains rules of an intense market shaping dimension. Limits on dark equity trading, position limits on commodity derivatives, granular rules on what the market looks like, all supported by highly technical rules. On the banking side, CRD4, CRR, one might regard it increasingly as an operational manual which supports the supervisory review and evaluation process. So what is the role of the lawyer who examines rules, where the rules are so granular, so technical, and the questions are often functional and empirical rather than legal? Certainly there are classification questions, certainly there are definitional questions, and increasingly there are constitutional and administrative law questions. But even after this huge period reform, I suggest there are still two outstanding questions which Capital Markets Union, or CMU, does generate. First, the role of regulatory reform in the ongoing financial market project. And secondly, the design of and the forces shaping institutional structures. So as to the first question just noted there on the slide, what is the role of regulatory reform in Capital Markets Union? Now, with CMU, the EU is going back to basics. It's returning to its roots. It's returning to liberalisation, to market access, and to market making, the single market in capital. And this is after an intense period of regulation, market protection, and market shaping, intervening in the shape of the European market. So that's the first question. What are the implications of this shift when it comes to regulatory governance? And the second question, what about the institutions? The institutions which underpin the EU financial system are still in a highly dynamic state, and an increasingly complex institutional ecosystem is under construction. The related EU administrative law is still in its infancy. So the second question is, how will Capital Markets Union shape or reshape the current rather fragile institutional settlement? So the talk accordingly looks at those two questions. First of all, looking at what is Capital Markets Union, then, and here I become a somewhat speculative academic lawyer, is it worth looking at? Is it an interesting development? And then I return to my two questions, the implications for regulatory governance and the implications for institutional governance. Now, Professor Lucantone has very ably just outlined what CMU is, so if you'll forgive me just for a couple of minutes, I'll outline a little bit more. So the CMU agenda was conceived initially by the Commission. So we immediately see the difference. The crisis era programme was driven by the G20. It was an international project. The CMU agenda was initially conceived by Commission President Juncker in summer 2014. And as is well known, the Commission presented its initial Green Paper in February 2015. This was followed by the action plan, the more detailed action plan in September 2015, which was accompanied by specific proposals on securitisation. Politically, a supportive European Council resolution was adopted on the 10th of November, just a few weeks ago, and the European Parliament is very broadly supportive. Now, Capital Markets Union, as Professor Luca Antone outlined, seeks to diversify sources of funding. It's seeking to move funding away from the dominant bank channel to capital markets, to strengthen funding sources and choice, particularly for smaller companies, for SMEs, to increase retail and institutional investor choice, to support long-term and sustainable investment, and all of this should lead to greater financial stability. Now, we should remember this is not new. The strengthening of market-based funding in the EU has been a policy concern as far back as 1966 with the Sequoia report. Neither is it new to capture this concern in a distinct policy agenda, CMU, with political backing. We saw this before in 1999 with the Financial Services Action Plan. And over the crisis, the capital markets agenda did come through with the SME growth market set up under MiFID II and the construction of a series of new fund structures, including the EU Venture Capital Fund structure, the EU Social Entrepreneurship Fund structure, and the European Long-Term Investment Fund. These vehicles were all constructed over the crisis era. But CMU does have two distinct flagship regulatory projects. First, reforms directed to simple, transparent and standard securitisation, or STS, and also securitisation more generally. Now, the securitisation reforms are designed to kickstart the sluggish securitisation market and so free up funding capacity. Now, I'd need to check my facts, but I think it is historically fast that on Wednesday, ECOFIN agreed its negotiating position on the two securitisation measures. So it's moving very, very quickly in terms of getting completed. Now, the second flagship project is radical reform, I would suggest, of the Prospectus Directive, which governs, of course, how companies access the capital markets. The Commission's proposal was presented only on Monday of this week, and it includes the following: the recasting of the entire directive as a regulation, moving to a single rule book. On the other hand, it's deregulatory. It exempts a wider range of offers from the prospectus requirement by raising the optional threshold at which member states may exclude an offer from a prospectus from €5 million to €10 million, and by moving the mandatory threshold below which a prospectus may not be required from €100,000 to €500,000. And this is designed to support crowdfunding. It has also come up with a harmonised regime for small companies, a harmonised proportionate regime for SMEs accessing the capital markets. There's also going to be a harmonised and lighter regime for repeat issuers who return to the capital markets on a regular basis. And with a somewhat heavy heart, because we have been here many times before, it is also reforming the prospectus summary. There's many other points in the proposal, but all of this is designed to ensure what's called the funding escalator from entrepreneurial firms, crowdfunding and so on, to smaller companies, right up to repeat established issuers, can access an efficient form of prospectus. But there's a very wide range of other measures. These range from the design of a new regime for covered bonds, to reform of the investment fund regime, to support venture capital, but also to support lending by investment funds, reform of Solvency II and CRD4 to reduce the cost of infrastructure investments, to very ambitiously wide-ranging reform of the related insolvency and taxation law, which continues to generate transaction costs for the capital market. The CMU agenda also includes non-regulatory reform, as Professor Luca Antoni alluded to, including support of private placements and the development of SME credit information systems. Retail investors, the Cinderella of EU capital market law, usually overlooked but occasionally brought into the system, are having their moment in the sun and are being pulled in as capital suppliers to the EU capital market. A green paper, a policy paper on retail investor issues is expected shortly. And to take a specific example, Monday's prospectus reforms are designed in part to provide incentives for issuers to issue small denomination bonds rather than in amounts of €100,000. So small denominations in order to support retail investor investment in bonds. So that's regulatory governance under CMU. So far, it does not have a direct institutional or supervisory element. It's based on standard single market arrangements and in particular on harmonisation and on support of supervisory convergence and coordination through ESMA. So CMU is accordingly very different to Banking Union. Banking Union is an institutional project designed to support risk mutualisation in the euro area through centralising supervision and resolution. CMU is really all about risk diversification and about harnessing market forces to support a single market in fundraising through long-standing single market mechanisms. But is it worth considering, going to my third point, is this a significant moment for EU financial governance? Is it simply transient, temporary political pyrotechnics? It sounds very good to an industry beleaguered after some 8 years of heavy regulatory reform. Is it simply a way of distracting from difficult questions such as the risk of UK exit from the EU? There are certainly grounds for suggesting there's nothing new here, as I said. It's simply another example of the long-running project to support market-based funding in the EU. And by focusing on Capital Markets Union, there could be grounds for distraction. There are significant competing questions. In particular, there is a pressing need for careful review of the crisis era period. Now, much of the crisis era programme has been adopted without a secure empirical base. The delay to MiFID II, its implementation, from 2017 to 2018, underpins the scale of the complexity. The review clauses contained in all the crisis era measures are beginning to activate, and they will require close attention, such as the EMIR review, which is currently underway. And when MiFID II MiFIR finally comes into force, and we assume it'll be 2018, one of the most important data sets ever collected on the interaction between law and markets, particularly with respect to liquidity, will begin to emerge and will require careful review. Significant legal issues are also emerging, notably with respect to proportionality. What does proportionality mean? Should it address the need for local market sensitivity? But then, what about the single rule book? How much difference do we allow for smaller market participants? But they may be a source of risk. Now, proportionality clauses are injected right across the crisis era rulebook, often as a means to achieve compromise. But at the cutting edge of market implementation, they can cause difficulty. This issue is becoming increasingly live and has important implications for the single market. Review is accordingly imperative, and there are many competing questions. Nonetheless, as I suggested at the outset, there are two important new questions raised by Capital Markets Union. The implications of its approach to regulatory governance and using rules to make a Capital Markets Union, and then secondly, the implications for institutional governance. So turning first to the implications for regulatory governance. So CMU is a mixture. There are highly ambitious new measures. The new regimes for securitization, the new regime for covered bonds. There are wide-ranging, very extensive revisions to long-standing measures, notably the Prospectus Directive, but also the investment funds regime. There is support of market-based cooperation, notably with respect to private placements. And very unusually for the EU, there's also a little bit of wait and see, particularly with respect to crowdfunding. CMU also includes very long-term projects, such as a more harmonised approach to insolvency and taxation. So what observations might follow from a mixed agenda like this? Well, first of all, great caution is needed in imputing strong transformative effects to Capital Markets Union. Remember, Capital Markets Union is a market-making agenda. It's constructing a single market in capital. By contrast with the crisis era market shaping, requiring features in the market to support financial stability. Now, an extensive empirical literature underlines that the relationship between law and financial market development is not clear. To take a very basic example, the regular data from ESMA on prospectuses and cross-border issuance suggests, as I think is intuitive, that extra legal factors, particularly macroeconomic conditions, drive issuance. And while the prospectus regime is relevant, it is not determinative. A series of studies have also thrown doubt on whether there can, after all, be an effective SME securitization market, regardless of the new legal constructs. Pre-crisis data suggests little appetite for this, and a great deal of joined-up legal industry work will be needed before the undercutting information asymmetries, which disrupt securitization here, can be addressed. More generally, taxation differences, different varieties of capitalism, and different industry structures remain significant. Great care is needed, therefore, to ensure the risks of this regulatory programme do not outweigh the benefits, because the benefits may be small. So then, what are the risks of intervention on CMU? Well, I think there are quite a few, but I highlight three in particular. First of all, distraction. Now, based on the Commission's September 2015 consultation, great effort will be put into recalibrating, finessing the new European Venture Capital Fund regime, perhaps by increasing the size of the funds which can benefit from the regime, or by easing the marketing rules which apply to these funds, or by adopting less restrictive rules on the assets in which these funds can invest, all to support venture capital. Now, all this may well be useful, but there are currently only 34 registered EU venture capital funds. It's also the case that venture capital funds can take years to construct. So it's very early days for this reform. Perhaps the better approach is careful review of the much wider Alternative Investment Fund Managers Directive, the AIFMD, which applies to all investment funds, and address its costs, and in particular ensure its controversial passporting arrangements are working efficiently. But this is a much tougher political project. Second, excessive regulation. Now here I turn to Monday's proposal for a new prospectus regulation. It seems from that draft that a harmonised, proportionate disclosure regime will apply to smaller companies admitted to multilateral trading facilities or smaller exchanges in Europe, in an effort to ease the costs for smaller companies. These trading venues currently are not subject to harmonised rules. Now, putting a harmonised rule in place runs the risk of removing a degree of competition and of choice in the system, without there being a significant prospect of smaller companies actually raising equity and bonds to significant levels. In addition, the regulated market, as certainly the students in this class will be very familiar with, which is the perimeter for all prospectuses, is the main gateway around the prospectus system. So blurring the difference between multilateral trading facilities and regulated markets could have unintended consequences. Similarly, the new prospectus regulation proposal provides, for example, for guidelines on risk disclosures and how they are ordered. But perhaps this is best a matter for the market, for due diligence, and for investor reaction, rather than regulation. I think the third risk is holistic or consistent regulation. For many of the capital market union reforms to work, they must operate seamlessly with other measures. Any removal, for example, of the current limit of €100,000 as the minimum investment in a European venture capital fund, reducing that to encourage retail investor activity, requires that the related distribution or selling and disclosure rules which apply to investors work effectively. It's not clear that they do. Similarly, the proposed deregulation of the prospectus regime must take into account the function of the prospectus as an investor protection document. More generally, the focus on the financialisation or the encouragement of retail investors across the CMU agenda sits very uneasily with the long difficulties with retail mis-selling in the EU, and in particular, low levels of enforcement. To take another example of the need for coherent regulation, questions have been asked as to whether a securitization, a standard securitization market can really be constructed when there are different insolvency regimes and different insolvency risks across securitized assets. Now, this is not to argue that CMU is misconceived or not a relevant project, but it is a call for nuance and for care, and for the more humdrum and more ordinary reforms not to be overlooked. Much remains to be done, particularly with respect to EMIR and its hedging rules, the AIFMD and passporting, and of course MiFID II, MiFIR, and its potential impact on liquidity. It would be encouraging for a capital markets union to provide a political and bureaucratic vehicle through which evidence can be assessed and reforms made. But it's not clear this will be the case. Secondly, moving to my second question on capital markets union. What are the implications for institutional governance, for institutional structures? Now here I speculate, because I think that's all we can do, that institutional governance under CMU will bear out the wider lessons of political economy and the wider lessons of a recent important strand of regulatory governance theory, a strand called experimentalist governance. Now, these two schools predict two things generally, which apply specifically, I think, to capital markets union. So political economists increasingly think that in the EU, major choices are driven not by national actors or political preferences, but by administrative actors, which are becoming more important. So in CMU, accordingly, the European system of financial supervision should come to play the determinative influence on how institutional governance develops. In addition, the experimentalist strand of governance theory suggests we won't see big, forward, dramatic developments, but it will be fluid, dynamic, and evolutionary. So in other words, the institutional settlement for capital markets union is likely to become more centralized. Yes, it will change, but it will be shaped by operational practices within the current structures, and in particular, ESMA. Now, just a reminder of the current structures within the European system of financial supervision, of course. We have the national authorities responsible for regulation and supervision, ESMA in a broadly coordinating role and supporting rulemaking by the Commission, the European Systemic Risk Board overseeing systemic risk, and somewhat uncomfortably, the banking union structure is sitting alongside that, but hitting off capital markets in some unexpected ways. Now, the swathe of reviews of this structure, which took place over 2014 from the Commission, the European Parliament and the IMF, suggest it's working relatively well. So what might CMU do? Well, I suggest there are three potential outcomes. Now, first of all, CMU might destabilise and disrupt the current evolutionary process if it leads to a change in current political conditions. Secondly, and less radically, CMU may strengthen the current evolutionary process if it supports evolutionary conditions. And thirdly, CMU may slow the current process by disrupting necessary reforms. But turning to the more dramatic model, disruption and destabilisation. How might we see a radical change to current governance? Now, one cause is likely to be a resetting shock, which changes the context and allows for the very significant constitutional, political, and legal obstacles in the way of a single capital market supervisor to be addressed. Now, one doesn't like to predict as to disaster, but probably it's most likely to be a severe liquidity crisis. This is something the Financial Stability Board and the IMF are concerned about. But the more likely proximate cause for major change is likely to be political. And political support for a financial union with centralised institutions arising out of capital markets union. So what then is being constructed? Is it a financial union with centralised institutions dealing with the mutualisation of supervisory risk? Now, coming from a UK perspective, this question goes to the heart of the current and growing tensions between the euro area and the single market would have been generated by banking union. CMU is currently being expressed as a single market agenda. This is clear from the Commission's agenda and more recently in the supportive European Council resolution in November. And Monday's proposal on prospectuses from the Commission specifically notes that CMU will, and I quote, work to the advantage of all 28 member states. Similarly, the policy trail suggests there is no Commission appetite and little appetite from ESMA to have its powers radically increased under CMU on the lines of banking union. The political context is also of critical importance. Any move to recharacterise capital markets union as financial union with centralised structures would be highly sensitive in the context of Brexit or the UK leaving the EU, and the prevailing sensitivities related to euro area and single market governance. Prime Minister Cameron has recently included the protection of the single market against the euro area in his list of treaty reforms. And yet, there may be considerable and disruptive centrifugal effects from capital markets union. The June 2015 Five Presidents report on completing EMU borrows CMU as a device to complete EMU. And it speaks of a financial union through which risk would be efficiently diversified. The European Central Bank has recently spoken of, and I quote, a vanguard group of member states within CMU, and suggested that the roadmap towards a genuine CMU include a single capital market supervisor. The Commission and the European Council have both underlined the role of CMU in supporting the transmission of monetary policy and in completing EMU. The recent and very controversial European Deposit Insurance proposal, unveiled on the 24th of November for banking union, is in part built on the insolvency law reforms associated with capital markets union. And the centrifugal effects pulling into the centre may be all the stronger as prudential regulators globally, the ECB SSM, the Financial Stability Board and so on, are now looking closely into the stability risks arising beyond banking and from capital markets. And we have, of course, the precedent. Banking union has established multi-speed governance for the EU financial system. But there are significant braking factors. Is mutualisation of supervisory risk essential for financial union in the way it was for banking union? This is not clear. CMU is more about risk diversification. The operational challenges are very significant. There is, for example, an immense diversity of actors in the capital market space as compared to the banking space. And this is clear from the importance of proportionality in EU capital markets law. The cross-border footprint is different. Home-host structures are used, and not simply the home-home structures for groups that are common in banking. Conduct supervision, at the heart of capital market supervision, is operational, hands-on, has strong consumer protection implications, and requires close supervisory contact. It is of a different nature to the liquidity and capital supervision strongly associated with banking union. And even if a financial union with limited scope could be envisaged, perhaps for CCPs, perhaps for trading venues, the difficulties remain very considerable in terms of how resolution could be constructed. And this is not even to speak of the treaty difficulties. There is currently no reasonable treaty competence under which a single market supervisor could be constructed. So turning and briefly to the last set of comments. So if institutional governance is going to be single market based and not directed more ambitiously to a financial union, what then for ESMA as the major institution within Capital Markets Union? So some brief comments first on ESMA with respect to rulemaking, and to conclude on ESMA with respect to supervision. So just a reminder of ESMA's role on rulemaking. So it proposes technical standards and it advises the Commission with respect to technical rules. And it can also adopt guidance and other quasi-regulatory products. Now, certainly I think the empirical experience suggests that ESMA is well equipped to manage the technical challenges of Capital Markets Union and the complex rulemaking which will be required. But there are stresses emerging with respect to ESMA's quasi-rulemaking function, which may disrupt its ability to evolve in an efficient manner and to support CMU effectively. Now, there are some signs that ESMA can develop imaginative, informal, experimental solutions to very difficult treaty realities. But CMU may disrupt the process by blocking necessary refining reforms. So while there are persistent tensions between the Commission as the constitutional location of rulemaking power and ESMA as the technocratic expert, empirical observation suggests the relationship is working well. And in particular, the Commission and ESMA have been able to develop novel and informal solutions to managing this relationship. They have, for example, agreed to an early review process under which informal legal review of ESMA proposals would take place by the Commission prior to the formal process, thereby speeding up the adoption of technical standards. And I think the recent discussions on the extension of MiFID II MiFIR from 2017 to 2018 suggest something of a technocratic alliance between the Commission and ESMA. ESMA has also proved able to address many of the difficulties arising with respect to guidance. The European Parliament has been raising some difficulties here recently, and in response, ESMA has adopted a more formal and transparent process related to how it adopts guidance. Nonetheless, there are areas where formal reform is needed, and CMU may disrupt this. ESMA is in particular, I would argue, in need of a suspensive power to suspend rules. What if, for example, a highly technical rule needs to be suspended urgently given its unexpected effects? The highly granular and market-shaping new rules now emerging, this instrument is liquid, this one must be cleared, this one must be traded. The implication must arise that these may be adopted in error, given the very, very shaky empirical base for much of these rules, simply because the data was not there. ESMA has called for such a suspensive power. It may be functionally and practically necessary, but resolution of this question generates very difficult constitutional questions. And Capital Markets Union may distract from this important issue. Similarly, who watches the watchers? The EU is currently groping its way to a new administrative law with these new structures, but it's in very, very early days yet. Good administrative governance, however, requires political oversight of administrative actors. This applies all the more where governance shifts to the EU level and in such a highly contested area of economic governance, and where increasingly technical decisions are being taken at a European level. But EU-level accountability, including ESMA's accountability, is legally designed to reflect the treaty balance of power, and in particular, the interests of Member State Council, Commission and Parliament. But accountability over granular financial market decisions requires closer scrutiny. Should we, for example, be designing new boards, new accountability structures? And if so, how do these structures fit within current treaty restraints? Now, there are multiple ways of thinking about accountability. A lot of work is being done with respect to international financial governance, for example, but the debate is needed, and CMU may draw attention from this debate. Turning finally to ESMA and just a few brief comments on supervisory governance within CMU. My prediction, as before, is that there will be no large-scale change, but an incremental and evolutionary response. Now, clearly, supervisory coordination, supervisory convergence, which is what ESMA does, is an important means of supporting the European capital market. It holds the promise of higher standards, lower transaction costs, and the protection of a degree of national discretion. It's constitutionally much less problematic than centralising power, is unlikely to generate significant institutional conflict, and operates close to market actors. And certainly, empirical observation suggests an appropriate evolution by ESMA. Peer review provides a useful example. In the last number of years, ESMA's approach to peer review is becoming more robust and more intrusive. The 2015 peer review of best execution, for example, is noticeably more robust and more direct in its approach than earlier peer review exercises. ESMA is increasingly showing itself capable of suggesting and admonishing its member supervisors where best practices are not met. But while ESMA is clearly competent to build an effective supervisory convergence and supervisory coordination model, there are difficulties which need to be addressed. And again, CMU may be a distraction. Specifically, there are legal grey zones around the operation of Article 19 of the ESMA regulation. Article 19 allows ESMA to impose binding mediation decisions where national authorities disagree. A useful power, certainly, but there is a difficulty as to whether ESMA can cut through supervisory difference where the difference reflects discretion, where different authorities have a discretionary view different from the other. But this power will become ever more important, particularly over CMU, if difficulties arise as to interpretation of new rules in colleges of supervisors with respect to proportionality. And to take a final example, the very many and different national decisions required in relation to transparency and market structure under MiFID II. I suggest that clarity or revision of Article 19 is needed. Now, the Commission is committed to examining Article 19, but there is a risk this will get overlooked with the new adventures under Capital Markets Union. So by way of conclusion, CMU represents an opportunity, certainly, but it poses risks from a regulatory governance perspective, particularly if grand designs on securitization, on covered bonds, on prospectus reform, if these are preferenced where more humdrum, day-to-day, but necessary technical reform is needed. And with respect to institutional change under CMU, I speculate that CMU is not likely to lead to radical reform, although it will drive an inexorable shift to the centre. But there are obstacles to ESMA's effectiveness which run the risk of being overlooked under the CMU agenda. In conclusion, therefore, I suggest this is not a moment for grand designs, but one for careful observation and adjustment. In this regard, CMU may prove to be a disruptive force if it distracts the EU from the regulatory design questions, however humdrum, however intractable, which need to be answered. Thank you for your attention.